Yeah, man, it's been a minute, YouTuber, since I done a video, and so I haven't done one like this in quite some time, but every once in a while, or once in a great while, because I deleted a lot of my old videos, I do videos like this where I usually go to the data. And so what I want to do is paint a picture for you using actual data so that you can understand my viewpoint and where I'm coming from, and you can make a decision for yourself as to what you should be doing. Okay, and so the first piece of data that I want to go through is Chicago PMI. And basically, in a nutshell, what this does is gives you an indicator as to how the economy is doing. This is the Chicago PMI, and as you can see, we're basically back to where we were back in 2009 as we were slowly coming out of the financial crisis. But as you can see, we're basically in recession territory, and you can see that things are looking very negative. And so, the interesting thing about this is that as we see the economy coming to a crawl, that the markets go higher and higher and higher. Okay, now we do get these swings where the market does correct, and I'm going to explain that to you at the end of this video, why you are seeing these swings. But the truth in this chart and what it's saying to you is that despite all the quantitative easing, that it's not helping the economy, and at some point, the Fed will lose control of the market. And when it does lose control of the market, it's going to be very, very bad, because the distortions that have been created in the market are at such a magnitude that when it does correct, it's going to be catastrophic. And so when I look at these things, it just makes me heed a warning. Like, do I want to play around in these markets chasing after something when I don't know when to call it quits? Unless you're a professional trader that's following this stuff all the time, even if you're running tight stops. I mean, I just looked at a company the other day. It was a big antivirus company that the shares went to 0 in 1 second. Okay, so do you think that your stop losses could be triggered fast enough to prevent you from taking a major loss? I don't think so. I've had stops on investments in the past, and I had stop prices, and I've actually seen sales go lower than that because the sale wasn't able to act quick enough to execute at the price that I wanted the sale to be triggered at, and so the loss ended up being bigger than what I wanted it to be because I wasn't able to execute that trade. But it says right here that the print at a contractionary 49, the first sub 50 headline print since September 2009. Okay, so when this is in a negative territory under 50, it's pointing to recession. Okay, now the next chart here I'm taking you into is manufacturing at a glance, and it's showing you the business activity throughout the country from month to month. And so in this second column here that you're looking at, this second column is last month, and this is this month. And so you can see that the PMI is at a slower rate. It looks like new orders are picking up. It looks like production slightly picking up 1.3. But here's the problem. Employment is going down majorly. Okay, so we went from a 54.2 down to a 50.2. So we can see that the labor market is stalling. As far as deliveries are going, from slower to faster. And when you look at these indicators where it says rate of change, this is somewhat misleading, because even though it's saying it's faster, it's really not that much faster. Inventory is contracting. We can see that it went from a 49.5 to a 46.5. Customer inventories are contracting. Now, this is a big one right here. If you look at prices, this is what the Fed is trying to avoid. Okay, in March, the index was at 54.5, and now it's down at 50.0. So what that's saying is we are battling with deflation. Okay, as prices creep lower, as demand gets smaller and smaller and smaller. Retailers don't have any choice but to drop their prices. Therefore, that affects inventories, because retailers are not going to want to increase their inventory if they can't get it off the shelf at prices that have margins included where they make profits, okay? Backlog of orders is increasing, so getting stuff to market is also flagged there too. Exports are slowing, and imports, it looks like we're still importing stuff, so that means we're not manufacturing anything here. But what's interesting is if you look at the overall economy, it's still growing, but it's growing at a much slower pace. When you look at the manufacturing sector, it's still growing, but it's growing at a much slower pace. This next chart, we're taking a look at the S&P and the Dow, okay? And we're looking at earnings and what happened for the first quarter of 2013. What I want to highlight for you is that 45% of the companies beat estimates, 55% missed. And if you look at the Dow Jones area, I mean, it's a little bit worse there. And so what that's telling you is that these companies are not making revenue like they should be making revenue, okay? So things are slowing down, okay? That's just another indicator that shows you, you know, if companies are not generating revenue, it means they're not making money, which means stock prices shouldn't be floating as high as they are, especially if companies are making less money, which means they're less profitable, okay? Now in this next chart, you know, we're going to take a look at earnings and revenue. Now, this is a chart that shows you what the revenue streams are looking like for companies. So in the end of 2012, you know, we had this big spike during the Christmas time, but revenues are actually down 0.3%. Overall, in S&P, revenue is down, okay? And if you look at earnings, and you can see that earnings has dropped dramatically and is basically flatlining in 2013. And so earnings is at a measly 3.8%. Now, why earnings is important is because it relates to GDP growth. And so in order to sustain a satisfactory level of GDP growth, companies need to be basically generating revenue and they need to be increasing earnings, okay? So what you're seeing here is a decrease in earnings, which means that GDP growth is not going to expand. It's not going to grow. We're basically, the economy is stalling right now, okay? So here's another look at another indicator which is very bearish, okay? This is the employment numbers. And as you can see from November 2012 to April 2013, you can see that employment is slowing down, okay? It's not picking up, it's slowing down. Companies are hiring less and less and less, which brings me up to another point, because 70% of the U.S. economy is based on consumption. So if you don't have good employment going on in a country, that means that people don't have money to spend to do consumption, which affects GDP growth, which affects stocks, okay? So if we were in a natural market and we had data like this, the stock market would be a lot lower than what it is. And this is why you hear a lot of analysts out there saying that stocks are very, very expensive, because they're looking at the underlying economic data and they're saying, wait a minute, based on what the economic data is saying, the stock market shouldn't be where it is right now, okay? Now, here's U.S. macro data. Here's another look. As you can see, the U.S. economy is basically slowing down. But due to quantitative easing, we can see that the markets are moving up and up and up. So as the Fed creates currency out of nowhere, you know, the markets move higher. As, you know, this revenue bleeds off, I mean, not this revenue, this currency bleeds off into the stock market and puts stocks higher. But the underlying foundation that supports higher stock prices is dropping dramatically, okay? And so at some point there will be a mean reversion, and my point in this is that this is a hell of a mean reversion, okay, from here to catch up. Here you can see the correlation. There was a slight drop here, but quantitative easing quickly catches up, you know, and you see correlation here, and then here's a huge divergence, okay? Economy doing bad, stock market making rich people more rich. Here's another chart for you. Now here's adjusted retail sales of general merchandise. As you can see, year over year, the percentage change is very bad, okay? Meaning that we're selling a lot less now than we were in the previous year, okay? And so if you look at the general direction here, it's not looking very good. I mean, you know, adjusted retail sales for clothing, not looking too good. So if you look at this, lower revenue means that businesses in the retail sector are not going to look to hire more people, which puts money into the economy. And so this is going to put further stress. It's a cycle that basically feeds on itself. In this next chart, I'm taking you over to Europe briefly because the trend is global. Okay, it's not just the United States that's being affected. It's a lot of countries that are being affected. Look at France. They're in a sharp decline. Italy's in 21 months of recession. You got Germany struggling. Spain, look at this. This is crazy too, man. So it's not just the United States, it's Europe, and 66% of corporate revenue comes from Europe. So if Europe is in bad shape, especially the power engines of Europe, then how is it that the stock market is going to continue to ramp higher if all these economic, macro, and global economic indicators are pointing to very negative territory? Which brings me up to another point. So here's a look at personal income, okay? So these little dark shaded lines that you see, these are recessions that happened in the past. And what I want you to pay attention to is where the line is at during these recessions, okay? Had a little mile on here, revenue drop, revenue drop, revenue drop. And the reason you see this change is because there's high unemployment and people lose income, okay? People lose income. And so therefore, you're going to see this go lower. Look at this was the last big financial crisis that we had. This was crazy. I mean, look how far personal income dropped. Now, what's interesting is that we're in a very bearish territory right now, which points to a recession, okay? And so while the stock market continues to ramp higher, here's another indicator telling you the real condition of the economy, which leads me to another point. The housing market. Now, you see news out there everywhere. They're talking about home prices are up, home sales are going crazy. Homes are, disappearing in a day. People are going into a lottery to try and buy a house, but the data doesn't lie. If you look at home ownership in the United States, home ownership is all the way back to 1996 levels and decreasing, okay? So, like I said in earlier videos, what's happening is that you have institutional companies, institutional investment companies that are buying homes by the tens of thousands in select areas and turning around and renting them out. They're sucking up inventory, not the shadow inventory on banks' books. They might be getting a little bit of that, but that's in the millions. But what they're doing is they're sucking up retail inventory, people that are selling their homes, and they're turning around and renting them out. Okay. This is creating a huge market distortion because it creates the perception that there's a housing recovery when in fact it's a rental bubble that's being corrected. You can see there's a huge decline in home ownership in the United States. And this has very serious negative implications because, when you think about personal income, the biggest tax write-off that you have is your mortgage interest deduction. Now, if you remember earlier in the year, the tax break thing that they had going on, that expired. So that was a tax increase. So can you imagine for folks that are now renting that don't have that mortgage interest tax deduction, what type of tax hit that they got? They probably had to pay thousands of dollars to the IRS, which is going to impact consumption because if you feel that you're going to get a huge tax bill at the next tax season, you're going to be very cautious about your spending. You're going to be trying to save money so that you avoid being caught in the red with the Fed because you don't mess around with the IRS, man. They'll take your money before you get it. This is very bearish when you think about how this affects personal income and consumption, which consumption drives 70% of the economy. Now, here's another indicator for you: the median asking rent for vacant rental units. Now you can see here that it's been going up over time and it looks like it's at this plateau level. Now the interesting thing that's happening in the housing market now is that there's so much rental property out there for rent that renters can pick and choose and they look to see how much money they can save. So even if it's just something different, they get to pick and choose, and what that's doing is putting a cap on how high that people can charge rent, because if you try to charge too much, they just go to the next person that has a lower price than you. Even if it's just $25 difference a month, it's still a substantial savings over the period of 12 months. And so I think this is going to have an effect on rental rates, what people can charge for rent. And this affects the spread. So what's happening is you got people out there in the market besides these institutional investment institutions that are buying tens of thousands of homes. You got folks out there borrowing money at 3%, and they're playing the spread by renting the property out and making money off the spread. The problem is that if rental rates drop because of market saturation, the spread is basically gone, and then the person that's using the leverage is in the negative, and then what ends up happening is that they're forced to sell. Okay, and if you look, you don't see this major swoon of housing going up like crazy. Okay, so I mean the activity that you see in the market now is for flipping and renting. It's not true growth where people are looking for homes to live in, you know, as an investment. So they're not getting mortgages, they're basically renting. Now here is some more charts to show you the effects of the rental bubble, and you can see how it's pushing up median home prices, and this is the average days on the market. You can see that it's basically dropped dramatically, and price per square foot and total inventory is flattening out because, you know, these financial institutions have unlimited firepower. They're able to borrow at virtually zero interest rates and buy these assets and turn around and rent them out. But the retail investor, the flipper, or the retail investor that's trying to buy and rent a house, they're borrowing at 3%, 3.5%, sometimes 4%, depending on what their credit is. And so, like I said, if rents get depressed because of market oversaturation, the little guy will get squeezed out of the market and will lose their money. Now, here's another chart that shows you the activity. So it's very spotty. You can see like year over year change. You see Detroit has a 15% rate change. Here's Las Vegas has a 17% rate change. Los Angeles 14%. But if you look at the 17%, you can see that in February, you know, 1.6%, 1.6%, it's an increase. It doesn't look like it's that major, but if you look at the cities that it's in, this is where the investors are going. And when I say the investors, I'm talking about the institutional investment companies like BlackRock. They're going to areas like Las Vegas. Here's Phoenix. Let's look at Phoenix because there's articles out there. You can Google them for yourself where they're buying tens of thousands of homes. There's a 23% increase. This company, I think it's BlackRock or Blackstone, they're like 37% of the market there. Okay, so when they stop buying, do you think that there's enough retail demand to cover that 37%? It's going to be very bad for the housing market. And like I said, for folks that are out there using leverage, meaning that they're going into debt, borrowing money at 3.5% to go finance a home to rent it out to play the spread, once that spread is gone, they're going to be in a trap. And they're not going to be able to get out of the property, and they're going to take a huge loss. Okay, 18% San Francisco, 10% Tampa Bay, that's Tampa and Florida. You know, Florida is seeing some huge demand and stuff from these financial institutions that are turning, you know, the housing market there into a rental market, not a housing market. Now, this brings me to the last scene for you guys. I want to give you a clear understanding of why the stock market is going higher. Now, these are the market operations that the Federal Reserve Bank will be engaging in for the month of May. The stock market is down right now because the Fed is not injecting any money into the economy through outright treasury purchases and mortgage-backed security purchases. And so you can see here on May 2nd, they're going to pump anywhere from 1.25 to 1.75 billion in freshly minted currency. Okay, they're going to pump that into the market. Okay, and when I say market, I mean the overall market to buy bonds, to buy bonds and mortgage-backed securities. Okay. Here's another one, 3.5 billion. Can you imagine in one day up to 3.5 billion US dollars in new currency gets printed to go buy treasuries and mortgage-backed securities from financial institutions that then get returned as reserves to be parked at the Fed, that get pinched off of to push the stock market higher? Here's another 1.75 billion. Then on the 8th, so just on the 6th you have up to 3.5, but then on the 8th you have up to 3.75 billion being injected into the economy. Okay, chasing after assets. This is currency that got printed out of nowhere. Okay, and look at this. I mean, you got on the 2nd, on the 6th, on the 7th, on the 8th, on the 9th, on the 10th, on the 14th, the 15th, the 16th, the 17th, almost every day on the 17th, 5.75 billion in fresh U.S. currency is going to be thrown into the market. This is like throwing money into a fire pit, man. And it's not even money. It's just electronic digital currency that's going to be chasing after assets. So you want to know why the stock market is going higher? Because the Fed is able to do this at will, out of thin air. Okay? This currency is not backed by anything. Okay? Nothing. It's backed by nothing. You know, and it's driving the markets higher. So think about, this is a lot of firepower. Okay? And I'm being very facetious in saying that this is, you know, a lot of firepower. This is mega firepower. I don't know any institution that has this kind of firepower where they can inject billions of dollars every day, virtually every business day, into the market to chase after assets. Okay? What do you think is going to happen when this stops? How long do you think that this is actually sustainable? And this is just the beginning, because it's the law of diminishing returns. Think about it. All this currency is being injected into the market right now, okay? And the economy is still headed into a recession. That's with all this currency being printed, okay? And you're supposed to chase after stocks? I mean, you can. You can. I mean, I'm not stopping you. You know, I'm not stopping you. But for me, this is scary. Okay, and this is just the beginning. Okay, and I'm telling you, at some point, this is not going to last forever. And the question is are you smart enough? Do you have the resources available to you that will fully protect you? You won't be able to hide anywhere. When this experiment ends, you won't be able to hide in gold. You won't be able to hide in silver. Everything is going to get hurt because it will come collapsing down. It's already, think about it, if the economy is going negative right now and the Fed is already printing this much currency virtually every business day of the week, what do you think? I mean, they're going to have to print twice as much as what they're doing right now if they want to keep the stock market moving higher and higher and higher. I think it's going to be the law of diminishing returns. You're going to see the swings get smaller and the corrections get bigger, you know, until finally something breaks. Because, you know, Sugar Pants Bernanke said himself, man, that the markets will always win. You can only manipulate something for so long. It's not permanent. Okay? And so I'm not an expert. I'm just some guy on YouTube that likes to do research and look at data. And I'm telling you now, I am a diversified investor and my portfolio is doing extremely well. I invest in precious metals because that's my way of actually doing actual saving, not investing, saving. Okay? And, you know, when I look at going after growth, I try to buy things that are depressed and go look where people aren't looking. Okay? So, I mean, everybody has a different investment style, and you know what works works. If it works for you, fine. But the key is that you have to understand the risk that you're taking. Okay, understand the risk that you're taking when you're playing in these markets, man, because this is what's going on right now. Okay, and I can guarantee you that come, you know, by the time the end of May come, if it gets really bad, the Fed's going to have to come out and do something else. So we know that Japan said that they're going to start buying equities. The Bank of Israel said they're going to start buying European stocks. But I showed you what was going on in the European economy. You can buy the stocks all you want. It's not going to fix what's broken in the economy. Okay? And so what it does is it creates market distortions. And so the market distortion, yeah, you can take advantage of it, but you have to make sure that you have the ability to get out when it's time to get out at the right time. If you don't, then you get caught in a trap. You know, that's my point. So, you know, I hope you guys learned something from this. You know, I don't do these videos too often, but me, I like to look at economic data to base my decisions on how I'm going to invest. Yes, I am aware of the market distortions in both the housing market and in the stock market based on quantitative easing, down to the point that I know the days that the market should go up because I know when they're creating currency to push into the market. The market's down today because they're not putting any currency in the stock market. But I guarantee you tomorrow, you're going to see a slowdown in the fall, and then by the 6th, you're going to see a big pop because 3.5 billion is going to get pushed into the market. You're going to see another pop on the 8th because it's 3.5 billion. You're going to see another pop on the 14th because it's 3.5 billion. You're going to get a big one on the 17th because it's 5.75 billion. This is the equivalent of a hedge fund coming online to go chase after stocks in the stock market. So it's just amazing, man. And at the end of the month, oh, it's a doozy. 5.25 billion is going to get created out of thin air to go chase after stocks. So if you put yourself in position, probably on the 28th or probably on the 22nd, you'll probably catch that big pop on the 31st. So, interesting stuff, man. When you look at all this currency, you can try and add it up yourself. I left it on the screen long enough, but I think it totals up to around 85 billion a month. So with that being said, I hope you players are out there doing well. Keep looking at knowledge from everywhere. Keep getting perspectives from everyone. It's best that you get information from all angles, no matter what angle it is. And then think for yourself in the end. What do you want to do? Okay? So I wish the best to all of you, every last one of you out there, including my fellow YouTubers, man. I want you guys to succeed, okay? Because in the end, it is about stacking your wealth, but you also need to be aware of the risk. So you guys take care, man, and I'll get at you on the next video. Late.